Okay, so we just looked at selling call verticals. So now let's go to the other side and look at buying call verticals or long verticals. Let's see how this works. So humor me as to why I picked all these numbers. You will see why in a second. So in this case, we're going to assume the stock price is 97.50. And you'll see why it all works out this way in a second. So if we're buying a call on a 97.50 stock, we'd always buy the call just below where the stock price is. So we would buy the 95 call. And when we do that, we want the stock price to go up. When we buy a call, we have undefined profit potential, right? It can go up to whatever number and we can make a lot of money. But the POP of making money on the trade is very low. On average, when we buy a call, it's about a 35% POP. And that's not very good. We've already seen that's less than a slot machine. So we don't want to invest our money on slot machine kind of odds. So what can we do to help improve our POP on this kind of thing? We can buy a call vertical. So let's go through and show you how this works. So again, we're going to use 97.50 as our stock price, and we're buying the 95 call to start this trade. So just like before, if we verticals, right? What's a vertical? It's a buy and a sell of the same option. So if we buy a 95 call, in this case we're going to sell the 100 call. Okay, well, that seems kind of weird, right? Because when we buy a 95 call, we're looking for that long shot. If it shoots way up, we're going to make a lot of money, right? Everything that is above $95, we're going to be making some money. And in this case, when we sell a 100 call, what do we want to happen? Well, we want the stock to go down. So anything above $100, we're going to be losing money. That seems counterintuitive, right? We want it to shoot up, and in this case, it shoots up, and we're kind of canceling out our profits. And that's exactly what happens. Everything above $100 here, as I'm going to label our POP strike price moving forward. So everything above 100, because we sold this call, we lose money. Obviously, when we bought the call, everything above 100, we're making money. But in this case, they're going to cancel each other out. So all our profits up here are canceled out by our sold call here. And we end up with this defined profit trade.